So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies. If they pass my initial research, how do I value and evaluate them after reading their financial statement? I will go step by step, including valuations when we get to that point, and how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. Hey, Jason here. Today's video, we're going to do an investment analysis of eBay. Before I get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, Spotify, SoundCloud, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. To subscribe and hit the notification bell if you're watching on YouTube, so you're notified every time we release a new video, and release new videos all the time. Okay, so in past videos, we've covered Zillow, US Steel, Archer Daniels Midland, ExxonMobil, Cody, Simon Property Group, and a bunch of other stocks. If you want to watch those, they are linked below this in the comment or in the description below this. I will also reference, or I will also likely reference, some of those past videos and some of the things I talked about in those specific videos, so I don't have to cover them here. For example, if I talked about the cash conversion cycle today with eBay, I referenced the Archer Daniels Midland video that I did, and if I reference goodwill or impairment or intangibles or anything like that, I might reference you to the Cody or the ExxonMobil video. Again, those are linked below this if you want to go learn from those as well. If you stick around to the end of the video, I'll also give you some free or links to free resources on how to become a better value investor, better investor, whatever you want to call yourself, faster by learning how to evaluate and value stocks faster. One more preface. I need to have this mini disclaimer here, apparently, that I didn't have in my first couple of videos, and a couple of people didn't like that. So this is for informational purposes only. I do not own stock. Any of the stocks I talk positively about. I do not short stocks at all. So I don't have any short positions in any stocks I talk negatively about. This is going through my visual preliminary analysis checklist. And these are my personal thoughts for informational purposes only. Okay, so now we got through all of that. Let's get to eBay. Get this out of here. Okay, as always, well, in this case, it's a little bit different. I know what eBay is. I've used eBay. I used to sell stuff on eBay years ago. So I'm intimately familiar with eBay, unlike many of the stocks I talk about where I don't even know what they do. So eBay is, as far as I know, still the world's largest auction site, secondhand site, whatever you want to call it. I don't even know what you would call it anymore. They transitioned their business model a few years ago, a little bit away from the auction model towards the buy it now. I don't know if that's still popular, frankly, because I don't sell on there like I used to. But that is a huge transition in their business model. First thing here, I'm a little bit surprised they pay a dividend, 1.3% dividend, not because they don't have high profits and cash flow to support it, but as a relatively new-ish company. Yes, I know they've been around for 20 years, but still, it's still kind of a tech company. That's a little bit surprising to me that they pay a dividend. This is one sign here that a stock might be undervalued. Again, I don't put too much emphasis on PE, forward PE, or price to cash flow, but this is one sign it might be undervalued there. Nothing else of note here. Price to book value. Book value doesn't really matter for these kind of companies. So the relatively high price to book. I remember reading when I first started investing that you wanted to always, or that you wanted to always, or that you wanted to never buy stocks above price to books below 2 or above 2, sorry. That means you pretty much buy no stocks today, unless they were old school kind of manufacturers type of stuff. So that doesn't really work anymore. Okay. huge increase in revenue up until 2014, and then a huge decline in revenue in 2015. I'm guessing in 2015, that's when it spun off PayPal. That would be my guess in why the revenue is lower. Sorry, my dog was barking at me. Get out of here, notification. Okay, operating margin, fantastic. I look for anything above 10% on a consistent basis. And its lowest operating margin was 19.6% in 2014, and in the trailing 12-month period is 25.2%. So this is fantastic. Again, sorry, all right, let's get back to this. I apologize for that again. The incomes operating income stayed relatively stable and grown over the last decade. Net income's been fluctuated quite a bit. So that's interesting. Frankly, again, I don't care much about net income. I care more about operating income and free cash flow. And both of those are stable and mostly growing. Free cash flow, like you can see a little bit down further, rose significantly up to 2014, and then has been slowly declining. I'm guessing after the PayPal spinoff, again, I'm assuming that happened in 2015. I'm guessing they took a big chunk of the cash flow, and then also it looks like the free cash flow spending is down too. So I don't know what they're spending the money on. Maybe the dividend increase. Let's see. Let's go back up to the dividends. Oh, so they just started a dividend in 2019. Nice. And that will likely increase over time because in the trailing 12-month period, they've earned $7.32 per share. While they've paid out only 62 cents per share, or their payout ratio is 18.6%. So their dividend will likely continue increasing over time. Oh, they have a lot of debt. Return on invested capital is 47.3. Fantastic. I would look for anything but 10% on a consistent basis, and eBay's surpassed that threshold most of the decade. But because their ROE is 173.8 as of this recording, compared to their ROIC of 47.3, that lets me know they have a lot of debt because ROE is levered by debt while ROIC is not. Free cash flow to sales, again, fantastic. I look for anything about 5% on a consistent basis, and they've averaged probably about 17.5 to 20% over the last decade. Again, fantastic. Cash levels, 20% of the balance sheet, great. Nothing major here. Long-term debt makes up 42% of their balance sheet, which we'll get more clarity on here in a second. Just notice this, debt to equity, 2.78. I look for anything below 1 in most cases to consider investment, but it really comes down to the absolute number. So we'll see that they don't have a cash conversion cycle, not surprising because they're kind of more of a middleman. They're more of a platform than selling stuff themselves. Interest coverage ratio, again, we talked about this yesterday with Zillow. You want this to be as high as possible, but they don't have a number here, which is interesting. It's like an NA. So in the past decade, it's been fine, but now they don't have any number, which maybe the data is just not coming in because they have positive net income. That's confusing. Maybe the data is just not coming in on Morningstar. I'm not frankly sure why that's not showing up a number of some kind there. Okay, they have $8 billion in debt versus $3.67 billion in cash, which is better than I expected. And their debt levels, while high and a lot higher than cash levels, are still not a problem because it's not even close to their market cap. As a general rule of thumb, if a company's net debt approaches their market cap, that's a big red flag. This one, yes, they have too much debt for. They create so much profitability though they can sustain a lot more debt. So my line of thinking there, as I'm thinking kind of out loud, is normally I don't like companies that have a lot of debt. Normally I don't even like companies that have elevated levels of debt. In this case, though, because eBay is so profitable and so consistently profitable, their debt levels don't bother me, which is probably weird coming from a value investor, deep value investor, conservative value investor. Their debt levels don't bother me because of how much profits and free cash flow they produce and how consistently they produce those great margins. Any major things of note on their asset side of their balance sheet, liabilities, frankly, none either on their liabilities. Because, again, normally this is why rules of thumb are important to know and also sometimes to avoid as well. Most of the time, I want a company to have a lot more cash than they do debt. In this case, eBay has a lot more debt than it has cash, but I don't consider it a huge problem because eBay has such a long history of sustained, frankly, great profit and cash flow production. What that also means is that they have competitive advantage, which they obviously do. They have switching cost competitive advantages, which keeps their customers, in this case, buyers and sellers, going to another product. They have network effects competitive advantages, which pretty much do the same thing in this case. They have the most buyers and sellers. So more people go to buy and sell stuff on their site. Pricing power, they don't really control that. Their buyers do, or their sellers and buyer do. The market controls that in this case. But yeah, those are the two ones that come to the top of my head is switching costs and network effects competitive advantages. Purchases of investments. So in the last, I will want to know what that is. They've bought about $38.5 billion worth of investments in the last year, while they've sold about $38.8 billion of investments. So I'd want to know, if I were to dig into their financials, what that is, because that's a significant amount. That's the size of their market cap, essentially. Bigger than their market cap. They've bought back some common shares, which I actually forgot to look at back here. Looks like they've been buying back stock, and they've been buying back stock aggressively, down from 1.3 billion shares in 2010 to 747 million shares in the trailing 12-month period. Should have seen that before. So they've been buying back stock aggressively. They paid off about almost $2 billion in debt in the last year, while issuing about the same amount, actually. Again, their cash flow statement is clean, pretty clean. I would want to know what some of those things are that I mentioned, but they're not necessarily a bad thing, any of them. Valuation, and shockingly, its valuation is not absurd either. PE, price to cash flow, forward PE, I look for anything below 20 on all those, and it's 14.9, 15, and 13.1 respectively on all those. And its enterprise value to EBIT is 12.2, which is slightly overvalued. I look for anything below 8. But again, with its competitive advantages, with sustained competitive advantages, frankly, with its huge free cash flow production, with its huge operating profit production, I would probably say that makes them about fairly valued right now. And frankly, eBay looks like it might be a good stock to own right now based on this preliminary level. I need to preface this because of the first time we've seen, if memory serves me right, we've seen a stock that I've talked positively about in this new series where I go through stocks like this. This is still just the visual preliminary analysis checklist I do. If, and we finally found one, if a company we found surpasses this visual preliminary analysis checklist, then I do a full written preliminary analysis checklist where I write more notes on them, do a little bit more in-depth research, which I can show in a future video, probably next week. That will include basic evaluations. That will include me giving more thoughts on some of the specifics that we've already kind of briefly touched on here. If a company surpasses that threshold and it looks like it's good to go on that basis, Then I get into reading the financial statements. The reason I do it this way is because, frankly, it saves me an enormous amount of time by not having to deal with terrible stocks. Let me bring you back over here so you're not just staring at the screen. The reason I do it this way is because I used to spend an enormous amount of time, frankly, wasted researching terrible stocks that if I knew what to look for, I could have figured out relatively quickly if it was a good stock or a bad stock or not. So I figured out, whatever you want to term it, a process that works for me to find and evaluate stocks faster, or to find and evaluate stocks better and faster, to get rid of the crap companies faster so I can spend more time actually reading financial statements on good companies. Saves me a lot of time because I don't start reading the financials until I find something that looks great. However, the one caveat to that is I'm glad I did it the way I did, reading financials first when I first started, because it helped me learn business models, competitive advantages, all that kind of stuff faster by actually reading the financials, not just looking at the numbers. So if you're just starting out, I would recommend actually reading financials as many as you can. But once you figure out what business models are, competitive advantages, and how to spot them based on the numbers, I would do something similar to what I've been showing in these videos. So next week, I will add to my schedule, actually probably a couple weeks from now. We've got Christmas coming up, Christmas break next week, New Year's break the week after. So maybe starting the first of the year, or the week of the first of the year, I will do a full preliminary analysis of eBay, and we'll see where that takes us, frankly. And I'll keep doing the other preliminary analysis videos as well. If you miss anything, or if I miss anything, if you thought I messed up on something, if I should have explained something better, let me know in the comments below. If you want me to look at a stock for you, let me know in comments below. So far, I think I've looked at 4 or 5 stocks for different people. And I think the first week or second week of January, I've got an entire week for Kajona Elston, who requested I look at 4 different stocks for him. If you want me to look at a stock, let me know in the comments below. I'll do it. This kind of preliminary analysis on the stock, the only companies I will not look at are banks and insurance companies. If you want more help on becoming a better value investor faster, make sure to check out the links below in the description. You can get my 5 free gifts, which includes my valuation template and the full preliminary analysis checklist, which you're going to see for the first time in a while. I don't think I've shown that in a long time, maybe a year or two, where I've done that. So you can get that as part of my 5 free gifts at the links below. You can also get a free PDF copy of my book, How to Value Invest, and our guide, 7 tips to picking great stocks and 3 times you must sell. You can get all 3 of those for free at the links below. And if you're looking for more information on how to learn better and faster with some more of my help, you can get information about a masterclass below as well. But until next time, have a great day. Talk soon. Bye.